This is Commodity Wrap. I'm Tony St. James. Special guest today is Brian Hoops. Brian is president, Midwest Market Solutions. And, well, we've kind of had a lackluster day in the row crops. Brian, had you and I talked yesterday afternoon, we could have talked about all the green on the screen as every contract in every row crop market was higher. Unfortunately, somebody put the red shirt on, and with the exception of oats, I guess oats moving higher, but everything else back in the red. Corn lower, beans lower, soy meal, bean oil losing a 5-day win streak and settling lower. The wheat market was lower as Chicago and Minneapolis both failed on an attempt to go to 5 straight sessions higher. And for the first time in 8 sessions, the cotton market was lower. So we'll start there and we'll work our way kind of around. But why the lackluster? It just seemed lackluster. Why the lackluster trade on Wednesday?
You know, it really was. Compared to what we saw on Tuesday, it was not only lower, it was disappointing because it was lower volume, lackluster, and on Tuesday we saw all kinds of fund buys. They bought over 17,000 corn contracts on Tuesday. Funds today sold an estimated 8,000 contracts. So very disappointing that we didn't have much of any follow-through from the strong close. And I think when it's that time of year that we're in, we're not going to trend higher, and sometimes we do trend lower during harvest pressure, but it seems like we're more of a sideways to slightly higher technical uptrending market in here. So when we get into periods of weakness, we see the funds step in and buy it. Today we didn't have that momentum to push us higher, and they ended up pushing this market back lower. Now, maybe something has to do with the weather. We had rain in the forecast for a couple days that talked about harvest delays, and we saw a bounce off of that news. Today we saw forecasts that suggest by next week producers will be back in the fields again. So maybe we're starting to trade that forecast a week ahead of time that shows us getting more harvest activity, more harvest data in the week ahead, maybe not so much for the next 6 or 7 days.
Okay. I have to admit, I'm not sure this is a reason at all, but there was something kind of big going on Wednesday as well that really had all the markets kind of watching, including the equity markets, precious metals, and that was a decision from the FOMC, the Federal Open Market Committee. Federal Reserve Chairman Jerome Powell had an announcement on Wednesday. What do we know?
So they did cut interest rates by 1/4 of a basis point in their first cut of 2025. So they've had 5 straight meetings without any change in Fed policy, and we always like to look at what the commentary is. The market had widely anticipated a 1/4 point cut, like a 99% chance. So we look ahead to next report or the next FOMC meeting. Will they do it again? And you look at the comments that were made, and he's speaking right now, but they had 6 Fed officials that did not see any more rate cuts in 2025, while 9 officials see an additional 2 rate cuts. So very mixed message, I think, to the trade here. It's not conclusive that there'll be another cut for next year, and we saw a rally initially after the rate cut like you would expect, but then the market sold off, it rallied again, it sold off again. It's very choppy here because we just don't have that clarification or that direction for the next FOMC meeting. Will they cut rates? Will we see another cut or not? And I think the market is going to have to react to this cut in rates and see if that helps to spur some of the economy and spur on some hiring practices before they are willing to make another cut.
Okay, and again, looking at the equities here, Dow has kind of been moving higher, but I think we really watch the S&P and the NASDAQ a little closer to get a gauge of the economy, if you will. Is that how you approach the equity trade?
Right. Yeah, I think we watch more of the S&P futures because they're so widely traded. You know, NASDAQ and Dow, they're certainly traded as well, but there's nothing that has more volume than the E-mini S&P contract. And so how that S&P contract trades throughout the day is kind of how I would consider anyway how the equity markets traded during that session.
Okay, and let's just kind of keep this rolling. The lower dollar, we saw Bitcoin pull back. Of course, the dollar has been slipping. It's down about 11% year to date, while Bitcoin's up 24%, but both lower on the session Wednesday. I'm just wondering, are we setting ourselves up for the potential for more crop sales with the dollar just continuing to pull back?
Yeah, that's a great question, and we want to say yes. With the dollar turning lower and weakening here after this rate cut, you would want to think that we're going to have more export business. A cheaper dollar means cheaper commodity prices for our foreign buyers. Usually that's great for export business. So I want to say yes, that's going to give us better demand trends. Corn demand is expected to be record large this year. Right now we are off to the second fastest export sales pace for corn in history, and USDA anticipates it will get even better. So we hope that that's the case, and we certainly hope that wheat has some stimulation so that we can bounce off of this $5 mark. Producers are not excited about planting wheat at this price level, and of course soybeans are off to a very poor start to their export season, one of the worst in history, and not having China as a buyer is certainly contributing to that.
We're talking with Brian Hoops. Brian is president of Midwest Market Solutions. Conversation continues in a moment. This is Commodity Wrap. This is Commodity Wrap. I'm Tony St. James. Special guest today is Brian Hoops. Brian is president, Midwest Market Solutions. First segment, we talked about row crops, really a lackluster day of trade on Wednesday. Talked about the FOMC and Chairman Jerome Powell, Federal Reserve Chairman, announcing a 0.25% cut in the interest rates, widely expected. There were some who thought it could go as deep as 0.5%, but a 0.25% cut. Stepping back for just a moment, Brian, with what the Fed has done and the comments that you've seen and heard so far, and just what we're watching in the equity markets, is there concern about the state of our economy right now?
Well, I think there is, and you can interpret the Fed cutting rates by 0.25% as a way to stimulate the economy because they see some concerns about it. The producer price index, a measure of inflation, has not really increased, but it's the consumer side of things, the consumer price index, which is showing consumer inflation on the rise. Not having great jobs numbers or jobless claim applications on a week-by-week basis and unemployment numbers on a monthly basis being higher than what has been expected, and our jobless rate being higher than expected tells us that maybe the economy is struggling a little bit more, and that's why President Trump has been pounding the gavel and asking the Fed to cut rates and almost demanding that they cut rates to stimulate this economy. It will help out our consumers. They pay less interest rates on their revolving mortgage debt, like credit cards and that sort of thing. It'll help them out. It'll also help homeowners by housing at a little bit cheaper price on the mortgage side of things, on the rates. So it's expected that this will help our economy, which should be a boost for the stock market as well.
But we've been dealing with some inflation. I used the word some in there, but we've been dealing with inflation. And in many instances, when something goes up, the price of something goes up, whether the value increases or not, very rarely does it come back down. Now, one thing that does go up and come down are commodities. gives us a chance to talk about the livestock market here. Obviously, we've been talking about high protein prices. Cattle market lower, both live and feeder cattle on Wednesday. Hog market pulling back. Any thoughts about where we are in the livestock market?
Well, if we tie this into the economy, the concern has been the consumer will run out of money to pay higher priced beef prices, and that will slowly hurt our consumer demand. And we haven't really seen it through the summer months, but now that we're getting into the fall months, we're past Labor Day holiday, and there isn't really that summer holiday grilling season holiday coming up. We're starting to see evidence that the cutout values are starting to fall, and that's a sign that demand is starting to pull back as well. We've dropped $15 in a week in the cutouts and $23 in 2 weeks as demand softens here, and that demand is going to be reflected in the cash price that the packers are paying. Now, there's bids in $239 in Kansas and Texas. That's only $1 softer than last week's trade. If we see some trade developing at that level, that would be kind of considered a little bit of a victory, but there's probably more weakness to come in the weeks to come through the rest of September, that we may see additional weakness in the cash markets translate into weakness in the futures markets as well.
All right, Brian, if we want to carry this conversation on, how do we do it? Where do we find you?
Well, yeah, you can find a list of our offices at MidwestMarketSolutions.com, our website there, or you can give me a call directly, 417-501-5132.
Yeah, it's Brian Hoops, President, Midwest Market Solutions. This is Commodity Wrap.